Welcome, everyone. Welcome to CEO Unscripted. My name is Alvaro Erize, and I am the CEO of CINC, and I am delighted to be your host here today. And I am especially thrilled to introduce Marco Santarelli. And Marco is an author, an investor, a real estate investor, and advisor. He's also the host of one of the most listened podcasts in real estate. But I haven't invited him for any of those reasons, or maybe because of one of those, which is I've been doing my own research as I prepare for 2021, for this year that is starting now. And it's tough to try to predict what will happen after such a variable year as 2020 was. Some of you may have heard my predictions back in April of 2020, and I wanted to have something real for us to prepare for 2021. And one of the best articles that I've found out there, best research, the power of the concepts, the clarity of the concepts, is Marco's of 2021 housing market in the US. And so given that, I thought I have the audience that needs to hear this. We will have the full article. There's no way we'll cover everything that Marco has researched for this in this call, but we will put it in the link in the comments. But at least here we get to hear it from himself, at least at a high level, and we can go as deep as these 30 minutes will allow us. So Marco, so many thanks for joining us here today, and thank you for being with us.
Alvaro, it's a pleasure to be on, and thank you for the invite.
Well, it's an absolute pleasure on our side, and I'm glad I have someone else with a last name that is difficult to say for other people. So that's a new one for me. And so tell us a little bit. Again, some people will be able to read your article afterwards. We'll put it in the comments. But talk to us a little bit about how do you see 2021? What do you see coming down the road?
Well, without getting into a lot of detail, I'm optimistic and bullish about 2021. The main reasons for that is simply this: we have a housing shortage. We are not producing enough in terms of inventory for what we need. We need approximately 1.6 million housing units per year, and we're producing somewhere between 750,000 to 1 million units coming online in terms of new inventory, new construction, and existing inventory that's coming online. And our household formation is far outpacing what we can put or produce. So when you look at our organic growth and immigration growth, it just doesn't keep pace or in step with what we're providing in terms of housing.
Yeah, we keep coming into your country.
Yes,
it's just too attractive to come here.
Yeah, and that's okay. The problem is that we have strong demand and a lack of supply, and that's been going on for a long time. And the problem is not getting any better. In fact, we probably see this problem going out as far as 2030. So builders are finally cluing into the fact that there's a big opportunity here. They're not just building homes for homeowners now. There's been a huge shift over the last 3, 4, 5 years to a model called build to rent, where smart real estate investors are coming in and they're saying, hey, the strategy here is to buy and hold, not buy and flip. Let's buy and hold properties in well-located markets, and let's rent these properties out to well-qualified tenants. So it's a win for the builders. It's a win for real estate agents and the people involved in the transaction. It's a win for the tenants or the people who are looking for good quality, safe, clean, functional homes to live in. And that's what they're getting at fair market rent. And those rents keep rising just because of the upward pressure that we see in the markets, lack of supply, too much demand. But that's what we're seeing all over the country right now.
But Marco, and you touched on what was going to be my first question. Why do you think that builders haven't been able to catch up? Is it still fear of what happened to them in 2008 when there was oversupply and it came crashing down? Because you would think that everyone should be rushing to this. We've been seeing this for a couple of years now, right?
Well, there's probably a lot of reasons. I don't know exactly what they would be. I would think that some builders were just very old school. They just build houses for homeowners. They never really think about the real estate investor. But then there's other builders who probably got burned back in 2008, realizing that there were a lot of people coming into the market who were not investors, but calling themselves real estate investors, and they were nothing more than speculators. They were just gambling on the market because their plan or playbook was to buy something and then have it built over 6 to 12 months and then flip it at the end for more than what they contracted it for, and making that spread, but that, that works for a certain period of time. But when the party stops, and there are no more buyers, or there's nobody willing to pay, the higher price, then you're left holding the bag. And that's what happened with a lot of people.
Agreed. And that I can understand has created some of this carefulness now. And going back to the conclusion of what you were saying at the beginning, so you think 2021 is going to be again a seller's market, where the demand is going to greatly outpace the supply of properties?
Well, yes, but the thing is when we talk about the housing market, I really like that term, but I dislike that term, because when you hear people talk about it, especially the mainstream media, or talking heads out there, they refer to the housing market as this one nebulous blob, which is the entire United States. And that just doesn't cut it. I mean, if you're just looking at taking the pulse of something, that might work. But the reality is we live in a country that has over 500 metropolitan statistical areas. And even with a large metro area that might be 500,000 to 5 million people, what's happening in where you live in Atlanta, Georgia, is different than what's happening in my backyard here in Orange County, California, or even San Diego, California. And that's different than what happens in Detroit or San Francisco or Houston, Texas. So real estate is definitely local, but arguably it's hyper local. So you can't really talk about markets and how well they're doing, the market, in air quotes, and how well it's doing without having more granularity. You have to talk about local markets and even hyper local markets, suburbs. So to your question, overall, yes, I'm bullish. I believe that most markets will continue to thrive. We may not see the same rate of appreciation that we saw in 2020, but for the most part, we're expecting to see, probably, and this is looking into a crystal ball a little bit, but probably a 2 to 4% annual rate of appreciation in a lot of the markets, especially in the lower and upper quintiles. In the mid markets, the second, third, and fourth tiers around the country in price points, we're expecting those markets to, or those layers or levels to appreciate beyond that, just because there is strong supply or strong demand and lack of supply. But here's the other thing too, and this is more specific to my point and your question. You have to look at markets as first tier, second tier, and third tier or tertiary markets. The top tier markets like Los Angeles, Chicago, San Francisco, and New York, these markets are suffering, particularly because of COVID. There's a lot of people who have realized, I don't need to pay these high prices. They're moving out of the market. They're moving to the suburbs. And that's why suburbs around the country have been booming. They're seeing an influx of people coming in, and there's no supply there in terms of existing inventory and new inventory to support the influx of that migration. So they're booming, whereas the cores of these inner cities, especially these large tier 1 markets, they're suffering. We're seeing property values stall or come down. We're seeing rents come down. San Francisco is seeing this across the board at every level, at every tier. So those tier 1 markets are suffering. The tier 2 markets are doing well. And the tertiary markets, which are the smaller outliers, are also doing well, because the people who can't afford to be in the tier 1 and tier 2 markets are moving further and further out to the suburbs and exurbs. And that's driving demand and pushing prices both in the rental market and the resale market out further. So that's what we're seeing.
And I think because there's probably more than one. So you mentioned COVID, which certainly is driving some people away from big, highly concentrated cities. But we've also seen an uptick in crime in some of those cities. And we've also seen the fact that because remote work is now more possible, it makes more sense to not have to pay those huge rents or property values. So that makes perfect sense. But going back to your previous point, so from the price point of view, not from the metropolis point of view, you think that the strongest performing of the year will, if I interpret it correctly, be the middle of the pricing range. So not the very high end or the low end, but the middle of the pricing range?
Yeah, the more affordable that strata is, the more affordable the housing is, the better it'll do. The faster
Okay.
it'll sell, the faster the turnover, the less inventory, the stronger the price appreciation, because there just isn't enough supply to feed that demand. And so that only makes sense. What, the extreme is you go up into the McMansions, the $5-10 million homes, depending on what market you're in. Those might sit well if the economy is doing well, if the jobs are there, if incomes are there, and people can afford those homes. But let's face it, the demand for those homes is probably not as high as it used to be several years ago. But here's the flip side to this whole equation. Affordability has actually improved.
Mm-hmm.
When you look at mortgage rates and how they've been coming down month after month, year after year, we're at historic lows. I mean, we're bouncing up and down, but we're at historic lows. So even though a lot of properties around the country and markets have appreciated considerably, in many markets 5 to 10% or more, we've seen markets that have appreciated, double digits, particularly in booming markets that you see peppered around the South and Southeast and Florida. But because mortgage rates have come down, the affordability has actually improved, because you got to remember, people buy based on monthly payments, not purchase price. So what they were looking at last year at $130,000, and now this year it's $140,000, $150,000. Their monthly mortgage payment, more often than not, is actually lower now than it was 1 year ago. So it's actually a more affordable house, even though it's a more expensive house.
Yeah.
And that's just further adding fuel to the fire and driving, a warm or hot real estate market. And again, I'm being granular
Yes.
here. I'm talking about local markets around the country. I'm not talking about, the country as a whole.
And do you think if we had a change do you think that there is a chance that we'll have a lift in mortgage rates this year? And if that happens, do you think that will change this appreciation significantly?
No, I was on a panel, what was it, about 6 weeks ago with Doug Duncan, the chief economist of Fannie Mae. And he gave me a slide, he gave the panel a slide with his estimate or prediction of what the mortgage rates will be like going forward. And he didn't talk about mortgage rates specifically. He was talking about the 10-year Treasury bond yield, the annual average. So in 2020, it was 0.9%. And his or their estimation is that it's going to be 0.8%, which is, a very tiny drop, but it's still a drop nonetheless. And if you even were to call it flat, the expectation is that mortgage rates are going to continue to be where they are today, at a very low, historic low. And I wouldn't be surprised if they drop a little bit more. Like it wouldn't come as a surprise.
So that's great. So you don't foresee a big change in that side. And so globally speaking, I know, as you said, that's not a great indicator. And when you said hyper local at CINC, that's what we preach. That's why we go super, super deep when we do our lead generation, and we go hyper local. But still talking globally, do you think number of houses sold next year compared to 2020 will be up, down?
That's a hard thing to answer, and I'll tell you why. And this is the challenge with what's going on. Supply is tight, and builders are not keeping up, although they want to keep up. So the baby boomers, who typically like to downsize as they age, are staying put. And a lot of this has been driven by COVID too. But baby boomers are choosing not to move. They're staying put. So that means that there is less inventory coming out onto the market that's going up for sale, that's available to buyers who are in the market looking for something. Secondly, Freddie has, estimated that between now and the year 2030, so roughly a 10-year window, we're going to have a shortage of anywhere from 900,000 on their lowest estimation to 4 million housing units on their highest estimation. So we're talking about a major supply gap here. If you go back to 2017, we were 370,000 housing units short. And so that trend is still continuing. We're not keeping up. But that shortage just leads to, an increased amount of occupancy in homes, an increased rental rate across the board. Rents keep going up, increase in property values, that continues to go up. So we have this problem with baby boomers sitting tight. We're not keeping up with inventory. The markets that are receiving positive net in migration from, the tier one markets like the New Yorks, the expensive markets where people are flowing out into the suburbs or actually moving to other markets like the South, Southeast, they're seeing population rates grow. And so the housing is not there. The supply is not there. So we're going to continue to see prices go up because that upward pressure is not going away. It's increasing in most cases. Long answer to your short question. The point is that it really depends on where we're talking about, but I do see that housing shortage to continue, and the demand for it to continue to go up. Plus, we got another thing that we haven't talked about, which I only have a few slides. We don't even need to use my slides if you don't want to. But
no, I'd love to see them. But yeah, tell me the last.
Yeah, just real quick. The other point is that we have this concept called shadow demand. Back in 2006, 2007, and 2008, we had this shadow inventory that fell out of that, where we had all this excess inventory, and a lot of it was really just built for the sake of being built. We didn't have a true market out there. People were speculating and buying and buying second homes and so-called investment homes to buy, fix, and flip, and it created this massive shadow inventory that ultimately became the foreclosure wave. Today we have something similar to that called shadow demand, and what that is it's something that's there that you don't see, but it is there and it's coming out. And that shadow inventory are all the people that are about to come into the housing market, looking for inventory, looking for a place to buy and live or rent, that is not out in the market yet, but they are coming. And these are the people that are the Gen X, the Gen Y, well, mostly the Gen Y, what we refer to as millennials, the Gen Y, the Gen Z people, and a lot of the young people who are living at home that are between the ages of 19 and 29. There's a lot of people that are young adults that are still living at home that haven't actually worked their way out into the market, whether it's a rental or a purchase. Yes. And it's at the highest in history. It's actually at 52%. 52% of 19 to 29-year-olds are still living at home. So
which for the US is incredibly high. In other countries that's more normal, but here it's incredibly high.
It's the highest in the last 100 years.
Wow, that I didn't know. And I'll tell you, I usually try to make all of our webinars actionable. And this one, I'm like, okay, we're talking about the market. There's not too much actionable there. But one of the main things that you said that I think is very relevant, where our crew can make a difference for the US in general, is this is a year where being more proactive in reaching out to sellers makes all the difference in the world. Because as you mentioned, sellers are at a stage in their life where they would be wanting to change homes, and for different reasons, they're staying put a little bit longer. And being able to communicate to sellers, because the builders will catch up at some point. So at some point, those prices will stabilize and even fall once the supply starts to catch up to the demand. So it's a great moment. It's a great year to be proactive, go out there, reach out to those sellers and get them moving and get the economy moving both sides. The supply is there. They can get their houses sold at a very good price, above what the seller naturally might think the price is worth. So that's a great actionable conclusion for our people of something that this year could be different from the year before, of focusing more on sellers than before.
Yeah, I mean, it's a two-edged sword. If you're marketing or farming for sellers to sell property, that's great. Depending on what market you're in, those properties will go under contract, within 2 days or 2 hours, depending on what you're selling. But then the flip side of that is the problem, and that is finding a replacement for the house you just sold for those people that are moving, and that becomes the challenge.
Yeah. And so why don't you show us a little bit of your slides of some of the key metrics that you're looking at that give you confidence in this and what you're thinking?
Yeah, so let me share my screen here. Just given the time frame, I mean, we could talk about this stuff for hours, but just given the time, I'll move through it relatively quickly. Can you see my screen?
Yes, perfectly.
Yeah. Okay. All right. So let me just go through some of this stuff here with you, Alvaro. So, I was working on this yesterday, and I kind of put together kind of a random or eclectic mix of slides just to kind of make some points. It's really not a story that I'm trying to build here. It's really just to provide some supporting information for what is going on and what might happen. This is just a reflection of what went on in 2020. And as you can see here, we were in a very, very strong housing market at the beginning of the year before, this COVID pandemic was announced. And at that point, it took a sharp dive. The recovery index, what I'm talking about is the housing market recovery index that Realtor.com puts out. And we saw that confidence level dropped considerably and bottomed out at the beginning of May. But then it quickly recovered and continued to recover, even with all the fear and everything that the mainstream media has been basically pushing out, on people.
Yeah.
And that is because the supply and demand, the economics trump, what
the narrative. The narrative doesn't survive reality when it comes to personal decisions.
Yeah. Sellers actually, it actually made an ongoing problem worse, because normally when we go into the spring and summer, buying season, the strong real estate season, that's when sellers are coming out, putting their inventory on the market. And what we saw is inventory dry up considerably because sellers weren't selling. They just decided to stay put because of fear. I mean, call it whatever you want, they had concerns.
It was, and look, I talked back in April. I said, look, people are going to delay their decisions. The issue is that real estate decisions are really unmovable at some point. If you're getting divorced, you're going to have to change houses. If you're having kids, you're going to have to need a bigger house. But you can delay those decisions 3 or 4 months, which I think is what they did. And we can see in the fantastic results of Q3 how that business ended up happening anyway, just a little bit later.
Yeah. So the housing market was running at a record pace, in the early stages of the outbreak around, February 2020, and that would have continued. The only reason that we had this pullback in this recovery index is just because of COVID fears, but that was short-lived. And, up until that point, we had 33 consecutive quarters of house price appreciation across the United States. Again, I don't like talking about real estate as, one big nebulous blob, because it isn't, but essentially that's what was happening. So, things are still continuing along this pace. It's very strong, bullish, and, short of being in the heart of New York or San Francisco, you're probably in a good market that's seeing overall strong demand and a healthy housing market. So this is something we could talk about for literally an hour. I'm just going to go through some points on this one slide. I talked about national trends about 4 weeks ago on another event. And, I talked a little bit about COVID. Home prices have been driven up, continue to be driven up. During this, this pandemic, according to the United States Postal Service, if you look at their change of address data, there were over 16 million people that moved during the coronavirus pandemic. Now, whether that was, accelerated because of COVID, I'm not sure, but I believe it is, because people started to realize that, hey, I don't need to, go to my office. I can work from anywhere. Mm-hmm. So, the bulk of people that were moving were largely leaving the large populated cities that I was talking about, like these tier 1 cities, New York, Brooklyn, Chicago, and San Francisco. And they were moving out to smaller cities in the suburbs. And that was driving huge demand in these smaller, these smaller markets and smaller suburbs. The states with the biggest cities lost the most people, the most movers, if you want to call them that. So who's moving? A lot of these people were college students because they can complete their courses online. And a lot of the people who could work remotely didn't actually have to be at a machine in a factory, that, they were good with a phone and a laptop. They could literally work from anywhere in the country, or even, from Belize if they wanted to. So a lot of these people who were remote or could be remote actually were able to move and did move. And I think the reason for that is twofold. Maybe one is to avoid catching the COVID-19, whether it's, fear fact, whatever it may be. But a lot of people just thought, hey, if I could move and get out of a densely populated area, I'm better off from a health perspective. And the other is obvious. It's just economic reasons. If you have the ability to move to a less expensive place and still continue to work and keep your employment, why not? So there are certainly economic reasons. And then affordability got better. We talked about this before, but because mortgage rates have been coming down, the ability for people to afford more expensive homes compared to a year ago has actually gone up. So again, people buy up based on payment, not based on purchase price. Now, I talk about supply being tight. Baby boomers are not moving. We've got this massive ongoing perpetual housing shortage. The only time we've actually had a net positive housing unit formation was 2 years before the Great Recession. So around the time of 2005, 2006, we actually had more inventory than we had demand. So this has been a problem that's been going on since the probably the mid to late 1990s. I guess it's a good problem, if you're a builder or a real estate agent, it's a good problem to have. But we're in this perpetual shortage, and demand is strong, and that seems to be the problem is Fannie Mae reports that we need 1.62 million housing units per year on average. I don't know how they came up with that number, but that's essentially what we need. But we haven't supplied that since 2007. So right now we have Gen Y, which are the millennials coming out. They're starting to move into the rental pool. There's 72 million of these people. They are coming out. They're looking for housing, whether it be rentals or purchases. And right behind them, we have Gen Z, which the oldest is now 23 years old. And, that cohort is somewhere between, depending on whose numbers you're looking at, 68 to 82 million people. So they're actually larger than Gen Y. And, that's just creating even more demand.
The demand is coming. There's no stopping it. Yeah, no, I agree.
Yeah, if you're a real estate investor, and this is, what our business focuses on, you have everything stacked in your favor right now. You cannot have a more perfect scenario going on. You know what I mean?
Yeah, absolutely.
And then last but not least, we have the shadow demand. It's, kind of like the shadow inventory of 2008. You don't see it, but it's there. But you have young people living at home, and I'll show you a slide here right after this one about, how many people are actually living at home. And these people are looking for more space, partly because of COVID. They're all cooped up. More people are living at home. So the density of the number of people living at home is higher. They're getting sick and tired of each other. They want to get back out. They want their own place.
I want to see that slide. I'm really impressed that has changed so fundamentally.
Yeah, and then the other thing too, which is not so anecdotal. I mean, there's information and data out there about it, but divorce rates have increased as well because of COVID. People being cooped up. So now you've got two people living at home, a married couple that are now divorced or splitting up, and now you're creating two households from that one couple, and that's even further driving demand, right?
Yeah.
So we've got this ongoing problem. All right. Well, real quick, the home builder confidence. This is 1 month old now. We've actually broke the 80 mark on this index, which is, I believe, the highest it's ever been since they started tracking what they call the home builder confidence index, which is a joint venture between the National Association of Home Builders and Wells Fargo. But it's very, very high. It's the highest it's ever been. And this really just shows
basically this, just for our audience, what it means is most home builders now feel that if they do start something new, they're going to be able to sell it. So they're very bullish and they're building and building more.
Exactly. Home builders and buyers are now feeling the highest rate of confidence that they've felt since 1998.
Yeah.
Which is very strong.
And I think we have like 5 minutes, but I do want to see the remaining slides.
Sure. Okay, well, I'm not going to spend much time on here. For those people who can see the slide, these are the largest gainers and losers of cities because of COVID. I just thought this was interesting to see how COVID has shifted migration patterns. The biggest loser being obviously New York. It is 10 times what it was the year before because of COVID, how many people moved out of New York City.
Wow.
But you can just see the biggest losers. I don't want to get political, but they're typically the blue areas and blue states. And the best gainers are almost always, the red states, just because they have lower taxes and business-friendly climates. They're just, it's kind of
and
not
I
much to
think
talk about there.
also with sometimes lower population densities too. And I think, as you were saying before, if you're very scared of COVID, you don't want to be in New York because you're scared of high concentrations of people. If you don't agree and you think it's not as bad as they say, then you also don't want to be in New York because you don't want the restrictions. So I think both, wherever you are in the spectrum, people are going towards less concentrated and freer places in the US. That's just the reality.
Yeah, that's exactly right. You're exactly right. Here's the slide you were waiting for. So going back to 1900 and looking at each decade, this is showing you the percentage of young adults that are living with their parents. And this decade, it's the highest it's been in history. So we are at 52% of this demographic living at home for whatever reason, financial or otherwise.
In Argentina, it's like 80%. So, but this is incredible for the US. Yes.
Well,
and as you say, I think it bodes towards the increasing demand that we will continue to have going forward.
Well, this is the shadow demand that I'm talking about. This is part of it, because at some point, people are going to move out sooner than later, and they're going to create a huge demand wave for rentals, which is great if you're a real estate investor, and that's who we deal with. We don't deal with homeowners and sellers. We're dealing with real estate investors. But for those that are working with buyers and sellers, you got to be aware of this. This is a demographic that you might want to go after or target or start marketing to, because they're going to be looking for help to get into the market, right? Whether it be rental or purchase. And it's a big, big number.
Awesome. I think Marco, this gives us a great, a little bit of a view of the fundamentals behind what you're saying. I think, again, going back to our original, the reason that I invited you here is the clarity of the concept. I think what you're telling us is 100% that prices are going to go up next year. The supply is going to keep strong. Not the supply, the demand is going to keep strong. And there's underlying factors that are telling us that there's more demand coming even after this demand gets served. And you at least don't see a shift in mortgage rates or any one event that would make a huge difference and change this dynamics. And what I really do recommend to everyone watching, if they can, is I think if they go into your article, which we'll post, you can read for a good night out of all of the fundamental factors that reinforce these concepts. From my point of view, and I'll leave you the last word because I'd love to get your sense of how are you preparing to 2021. From where I see it, as a technology company that enables the best agents in the country, we are preparing our clients for growth. We are preparing ourselves for things that allow them more leverage and more expansion. And I do think that being proactive on the seller side, given the nature of the influences that you're mentioning, will be critical in the next year. Any agent, and most of our clients are mainly working on the buyer side because it has been so strong for so long. But it is very clear that this is still going to be a seller's market in many ways, and that we will have to be more proactive as a real estate industry in enabling those and allowing those people to put their houses on their market if they want to. So anyway, that's my takeaways from looking at your article. But I'll leave you the last words. I'd love to see how do you prepare for 2021, and how are you preparing your investors for 2021?
So, 2021 is, I'm trying to think about this from the perspective of a real estate investor and a real estate agent. Thing is you just need to understand that short of being in a troubled market, some like I was saying before, the heart and core of a San Francisco or New York, at least temporarily for the time being, you really need to focus on increasing your access to inventory. Like if you're farming or marketing or whatever you're doing, you need to be able to get your hands on inventory, because if it's not in a war zone, it's in a good area or a great neighborhood, it's going to sell very, very quickly. On the flip side, there's going to be a lot of buyers out there. It'll probably be like spearfishing in a barrel full of fish. You shouldn't have a problem finding buyers, because there's a lot of them and there's more coming. The demand is strong. I think the challenge in the new year is just finding inventory. I mean, from where we sit, we're in 25 markets working with real estate investors. We have a good flow of quality turnkey inventory, investment properties, but it's a constant challenge, literally daily, to have that flow. And so I think the biggest challenge is really just getting the inventory, finding the quality inventory that you need to keep your business running. So just focus on sellers, focus on, if you're working with builders, focus on builders to get that inventory. I mean, sadly, builders don't actually need you today. There's people.
But we have some savvy listeners out there that will get to the builders anyway.
Yeah, but people are knocking on their door all the time.
Mm-hmm.
They just don't. They really don't need the help today. So as long as you have that, in your head, you can focus your business building and your marketing towards where you should be, and that is to get more inventory from existing sellers. Wannabe sellers. Those are not selling yet, but could be. And that's where we can make our influence. Yes.
So absolutely. And Marco, I really want to thank you once more. This is very, in a world of opinion, of unfundamented opinions, having someone do the research and have a thought of what's coming is extremely valuable. I really appreciate it. Thank you for joining us. We'll find a chance to have you again. And I hope you have a great holiday season.
You too, Alvaro. Thank you so much. Appreciate it.
And thank you everyone for joining. Have a great year.